Hi, welcome to today's video and thanks for joining me. Today we're going to be talking about this subject, RRSPs, and what you need to do before you retire. Now, many of you see me doing all these videos on my channel about retirement planning and optimizing your CPP and getting a withdrawal strategy done. But some of you may not know that I'm an investment advisor. I actually manage my clients' investment account. So yes, I'm doing retirement plans and I do insurance. I'm insurance licensed, but I also manage my clients' portfolios. And so today I wanted to share with you an observation of what I notice most commonly among people who are about to retire, what I see in your portfolios, and I want you to be prepared so that as you get into retirement that you don't have these two areas that really could spoil your retirement or just make it much more expensive for you. So if you can fix these, and you can, if you can fix these two areas, you're going to have a much smoother and a much better retirement. So let's get into the two areas. And by the way, as always, put your comments below. I love reading your comments. Okay, let's get into the two areas. The most overlooked areas of your retirement investment accounts that could jeopardize your retirement is actually these two things. One is having multiple investment accounts across multiple companies. I very, very often see when people come to me to manage their money and we have to chase down their accounts in several different financial institutions and have several companies. And I'll get into more about that in a second. And then the other is just not knowing or not understanding what your asset allocation is. That's a big word and some people don't know what that means because it's the kind of language that we use in the industry. So I'm going to break that down so you understand when we talk about asset allocation, what are we really talking about? So let's get into the two areas. Let's work on the first one, and that's understanding having all these multiple accounts. The first thing you want to do is you want to consolidate your RRSP accounts into one financial institution. Now, I know many of you will say, oh, don't put all your eggs in one basket. You're not putting all your eggs in one basket. You don't split your mortgage for your home up into 4 mortgages, do you? You have one investment company that does your mortgage for the last 25 years. Maybe you switched companies throughout that time, but it was one financial institution. And very often, it's the same institution that you might do your banking in and where your deposits go in and then you invest. So you already are doing the things that you are saying you don't put all your eggs in one basket, but you're already kind of doing that most of your life. There's no danger in you moving all your money to one institution. So let me show you exactly why you'd want to do that. One is having better portfolio oversight. It's easier to track your asset allocation in the investment performance. I'm going to get into asset allocation so you really understand what we're talking about. Having multiple investment companies. Do you see yourself in this environment? You might have Sun Life, for instance, in your group RRSP, so your group retirement plan. Very common. Most people have, either Sun Life or Manulife or Great West Life as their group provider. So you've got a Sun Life RRSP. Then you might have like a brokerage account, like Quest Trade that I'm showing here, or you might even have Scotia iTrade. So you like to do some of your DIY, do-it-yourself investing. That's great, but you've got maybe 1 or 2 of those accounts because you started investing in one company, decided to go to another company, but you kind of kept both. And then you might even have just your banking at one bank. I'm not favoring TD, I like the icon. It looked good against the blue background. But essentially, you've got 4. I see this so very often. Because you've got a group RSP, what can you do? You do have a group RSP, so it's going to be held in Sun Life. And then when you go to retire, the big question you have for me is, should I keep my money at Sun Life? Not picking on Sun Life, but should I keep my money in the company that was managing my group retirement account when you were working? Should I just leave it there? Or should I move it to the financial institution where I do all my banking? But the question is, which one? You have 3 other ones that you're dealing with. So you really want to choose one, consolidate all your RSPs into one account and manage it. Why? Because it's much easier for you. Let's show you what happens. Asset allocation. Asset allocation refers to how your portfolio is put together with stocks, bonds, cash, real estate, crypto, hard commodities like gold and silver. Maybe you're actually buying physical gold and silver. And so when you decide how to put your portfolio together and divide up the allocation, right, asset allocation among these kinds of investments or securities. When I said real estate, it could be a REIT, it could be actual real estate properties that you own. So when you look at your total investment portfolio and you say, okay, how much do I have in each one of those categories? That's what we call asset allocation. And then the other part of that is making sure that you're not over investing in one area as compared to the other areas of your portfolio. So if you have 4 RSP accounts or 3 RSP accounts, you have to do this asset allocation in each one of those accounts. You have to figure out how much stocks do I have in one, how much mutual funds do I have in one, how much ETFs do I have, and are they sort of complementing each other? Meaning in an RSP account, you may have a mutual fund, let's say, and let's say it's a balanced mutual fund. So 60% of the money is in equities, 40% of it is in fixed income, meaning bonds, right? And what kind of equities? Are they only in North America, only in Canada, only in the US? Is it overseas? And what kind of bonds do you have? Do you have corporate bonds? Do you have Ontario provincial bonds, for instance? So you want to understand the composition of your portfolio, and you have to do that in each one of those accounts and hope that you're not doing any overlapping, meaning what you have invested in one RSP is not the same thing you have in the other RSP account. So it makes it very complicated for you to track this, especially as you go through to retirement. You are already feeling like overwhelmed, worried, anxiety about retirement, stopping work, letting go of that part of your life and beginning a new part. And also now you have to try to figure out how to manage 4 or 3 or 2 different RSP accounts in different companies. Very, very challenging to do. The next thing that you're working on is having multiple RRIF payments. At some point, you're going to have to convert your RSPs to a RRIF. And this becomes even more problematic, especially for the people who are doing it yourself. You have to make sure, if you're doing all the investing yourself, you have to supply enough money to be on side of having the minimum, at least, RRIF payment that you're supposed to give yourself each year. The government says, take this amount of money out of your RRIF each year, and you've got to decide which stocks, bonds, mutual funds, ETFs that you're going to sell to raise the cash to pay out as your RRIF minimum. Having multiple accounts, you're going to have to start thinking about which securities am I going to sell. So by consolidating your accounts, you don't have to worry about 4 or 3 different accounts. You have one RSP account, and it's easier for you to go through the securities to figure out which ones you're going to sell or redeem to actually provide that minimum RRIF withdrawal. So that's a particularly troublesome way to manage your portfolio as you go into retirement. Very confusing. A lot of time being spent on which securities are doing well, which are doing bad. That's a lot of administration to do a portfolio, especially do it yourself, where you're having to track all these things. And then 4 RRIF payments going into your bank account every single month or annually, depending on how you do it. Now, the other thing is just improved tax efficiency, having a more strategic approach to your withdrawals and contributions. You may have seen me when I'm going through the withdrawal strategy on the software, and I'm showing you doing withdrawals, right? Melting down an RSP or melting down a RRIF, and I'm just showing that one account. When I have clients that have multiple accounts, I have to do one bank, will say one company you've got your RSP with, and be aware of the tax consequences of doing the withdrawals. Finish that one, get you out of your RRIF by a certain age, then move on to the next account. I mean, that's work I can do. Thinking about how you do it yourself and having several accounts, man, that is tough. That just adds anxiety to your retirement. And then simplified management, so fewer accounts to monitor. This is exactly what I was getting at. So it's easier, less time consuming. You don't have to be doing the same work all the time. So consolidate your RSP accounts. Now the second area that I spoke about is just asset allocation. So again, asset allocation also goes into the types of accounts you have. So you might have, and this is what I see very often, is a lot of people have most of their money in one type of account. So in this example here, showing you the RSP and then a sliver of TFSA. Some of you don't have TFSAs at all. And so all of your withdrawals are going to be coming out of one account. So you want to be aware of that as you go to retirement. If you're 5 years away, start building up your TFSA account, start to transition some of your money into TFSAs, because it is very, very useful in your retirement withdrawal strategy. So that's one area. It could be by account type, and the other is by the actual securities you have in your portfolio. Very often I'll see a portfolio where they have one or two funds for $500,000, and I'll say, what is going on? Why do you only have one or two funds? And most of the time it's not that you're just negligent, it's just you're not sure what else to put your money in. You're either doing it yourself or you had bad advice and you didn't recognize it as bad advice, because after all, you're taking the advice of the advisor and they suggested just two funds for $500,000, which is pretty crazy to only have two funds. So I would recommend that when you look at your asset allocation, you want to be well diversified and you want your portfolio to do a number of things for you. So when we do the retirement plan and we look at your withdrawal strategy, that is being looked at simultaneously as what is the impact of your tax rate, but also at the other part of what's your goal? How much money did you want to receive out of your portfolio? How much money you plan to spend every month or every year? Your portfolios have got to drive that income for you in the most tax efficient way with the least amount of time that you have to figure out what funds to sell or what stocks to sell. So you have to have well diversified portfolio so you're not being exposed to any market volatility. That's the biggest reason here. And then take opportunities, right? Take advantage of opportunities. When some areas are not performing as well as you'd hoped, the other areas of your portfolio are doing more of the heavy lifting for you. So again, asset allocation plays a massive role in having longevity of your money throughout your retirement, so you can actually enjoy your money and not be too worried about too many negative returns. So how do you fix this? Get a second opinion. Nearly any advisor that you ask, would you mind looking over my portfolio for me? They're going to do it for free, and they'll be happy. They'll roll out the red carpet, because that's you putting your hand up saying, I might be a client. Now, there's no obligation usually when you're talking with an advisor. They're happy to give you a review. Just make sure you're going to the right advisor. You want to make sure that that advisor actually manages the kind of portfolios that you might have. So many advisors will focus on a type of client. So maybe they're in the family market and they're used to lower dollar amounts and helping clients with budgets and high mortgages and kids going to school, and it's a very difficult time for families, right? And then there are other advisors that mainly focus on, let's say, older people 50 and above, which is my area of who I focus my attention with. And they're more accustomed to designing portfolios that have the right kind of risk involved in a portfolio, and understanding that you've got 25, 30, 35 years in front of you and you want to develop the most tax efficient income strategy. It's not so much about accumulation anymore, it's about income. So get a second opinion from an advisor that you believe is the right kind of advisor for you. And then the next thing too, and this maybe you could put this ahead of the portfolio review, and that is get a risk tolerance questionnaire done. So anybody who wants a risk tolerance questionnaire, just email me and I'll send you this questionnaire. You go through it. At the end of that questionnaire, it's going to tell you, are you a balanced, are you conservative, a moderate, aggressive, advanced investor? And that'll help you to develop what kind of securities to put in your portfolio. You shouldn't see that your RSP and your TFSA and your non-registered account should have the same risk tolerance, unless you're just totally either uber conservative or you're very, very aggressive. Then maybe you are, but most people should have a slightly different risk tolerance in each of the accounts. What I find very often is that, at least the people that I talk to, they don't really need their TFSAs in retirement. If you've got a big RSP account, it's unlikely, when I say big, over $800,000, it's unlikely you're ever going to use your tax-free savings account, because you just have so much money to get through in your retirement by doing the RRIF meltdown and RRSP meltdown that you actually never touch your TFSA. And with that in mind, if you're never going to be using that money for your retirement, you may want to consider to invest it differently than the way you're investing in RSP. So have a look at the risk tolerance questionnaire, fill it in. It's for you, so you can design your own portfolio the way you think it ought to be. Well, hey, that's a quick video. I hope you enjoyed today's video. Again, thanks for tuning into this video, but one last question I have for you. Ready? Okay. As retirement is approaching, do you find it difficult to develop a withdrawal strategy? So many of you contact me because you're trying to figure out exactly how to withdraw your money out of your RRSPs, your LIRAs, your non-registered, your TFSAs. And like what I mentioned earlier, you have several accounts and you're trying to figure out a withdrawal strategy. So it's just a question I'd love to hear you guys comment about is, besides getting ready for retirement and making the decisions about when to retire and being nervous about that whole environment, do you also find it kind of difficult, or not so much confusing, but you look at your portfolios and say, it's kind of a challenge for me to figure out which accounts do I draw out of first, but how much do you draw out? Put your comments below. I'd love to read it. And I know a lot of other people want to see what are the challenges that other people are going through, so they don't feel so alone. That is actually a great question, and many of you are going through it, so your comments might be helpful to them. Again, thanks for tuning in this video. I hope you enjoyed it, and I look forward to seeing you in the next video. Thanks, and be well.